So let's try to fill the theoretical part now with a couple of practical examples with the idea to understand what relevant and what irrelevant costs are for decision making. We said, of course, before which of the types of costs are relevant and which ones not. But if we take, let's say, a couple of practical examples, then we will see that sometimes in real life it's not that easy to determine which costs are now actually relevant and which ones we should disregard. Let's take an example of a garage. Let's say a garage buys a defect truck for $10,000. The truck could be sold immediately again for $9,000. And that's also something that you usually see if ownership is transferred. Sometimes the value drops directly, and there's also if you buy, let's say, a television, and you want to sell it again to somebody else, then probably, or in most cases, you will not get the same amount of money than the amount of money you paid, unless, let's say, it's a good friend of yours, and then you just agree on the same price. But if you sell it, let's say, on the market, it would be a second-hand television then, and then you probably don't get the same amount of money anymore. Let's say the defect truck requires a new engine costing £2,500. That will take 20 hours to fit. So your engineers or your technicians have to take 20 hours to basically fit that engine or install that engine in the truck. Then the technicians will be paid £15 per hour to fit the engine. And the technicians are at this moment short of work, but you want, or the garage wants to retain their services because they know, let's say in the future, we're going to have more work again. So we don't want to fire anybody at this moment because it's difficult to find good labor or good workers. So we keep them no matter what they do. So if they read a newspaper or if they work on something, they are, let's say, employed by us, they get the £15 per hour, and they now should work on the engine. And the question is, of course, now, what is the minimum price that the garage should charge for the truck after the engine has been fitted? So this means we don't want to sell it immediately, but we basically compare the situation of selling it immediately with the situation of selling the truck with the engine. And there are, of course, a couple of costs indicated here. And so if we now calculate this, the first thing is the opportunity cost of selling the truck. So this is the £9,000 that we would get immediately. So that is something, let's say, the alternative route we can take of selling the truck immediately. We don't use the 10,000 because we can't get the 10,000 anymore. That was the historic cost or past cost or sunk cost. It's not relevant for the decision because we can't get that anymore. Because let's say the market value in this case would be 9,000. So it would be an opportunity cost because we could take the decision to sell it immediately for the 9,000. Then we have the cost of a new engine because we have to buy the engine for 2,500. So that's simply mentioned here, and that's it. So we have £11,500. That would be the minimum that they should sell the truck for at this moment. Of course, they should add a little bit, a certain percentage here to make a profit. But why do they not include the technicians here? And the reason for this is quite easy, because the technicians actually are paid no matter what they do. So there are no additional costs, no extra costs that are incurred with having the technicians in your company. And so in this case, there is no extra cost. And so we basically here want to find the minimum price. Of course, we can also decide to add this, let's say, amount per hour, multiply with the 20 hours and add that here. But in this case, we just look at the minimum price, at those additional, basically those costs that are relevant for the decision that we take. This is relevant because we could immediately sell it for 9,000. That's basically the market value, we could say. And we have to add the 2,500 because that's additional money we have to invest to get the engine. But here in this case, the £15 an hour and the 20 hours are not relevant because the technicians are there anyway. If they read a newspaper or if they work on the engine, they get £15 per hour anyway. And we only look at minimum cost or minimum price here. Let's take the same example, but now let's say the technicians are busy and are usually charged out at £50 an hour. So this means usually they work on other projects and the other companies pay the garage £50 per hour. We have to be careful here with the 15 and the 50, because the 15 is what we as a garage pay to the workers, to the technicians, and the 50 is what we as a garage get from the other customers that our technicians work for. Let's say company B comes into our garage, they want to have certain repairs, then we as a garage get £50 an hour, and of this 50, our technicians basically then would get the 15. But this changes the whole situation, because if we now would work on the truck, then we would lose 20 hours of time, because our technicians cannot work on the projects of the other companies anymore. And so that's why the minimum price would change. But how would it change? Basically, we would now have to take this into consideration. Let's go step by step. We still have the opportunity cost of the truck, because we could still sell it for 9,000, which is then the alternative route we can take. We still have to buy the new engine. And now we also have the opportunity cost of labor, because if our technicians work on the truck, they don't have the 20 hours to work on other companies or other customers. And so basically we would lose £50 per hour, multiplied with 20 hours that the technicians need to work on the truck. So that's another £1,000 that we would lose. And so here the total cost would also be different, or the minimum price in this case would be different that we should charge, because in this case now the additional cost, or the relevant cost, would be also the 50 of the technicians that we would get as a garage, multiplied with the 20 hours that basically they work on our truck now and not on the other customers. Let's take another example, an example of a contract bid. So let's say a clothing company wants to make business with us, and they bid for a contract that requires 800 kilograms of organic cotton. Let's say we are a company that, let's say, either produced or bought organic cotton. And let's say this clothing company comes to us and knows we have this cotton. And in our case, let's say this organic cotton is currently held by our company, so we have 800 kilograms on stock, but we don't use it anymore, because let's say one of our products that use the organic cotton is not sold anymore, and so we still have this laying around, the organic cotton. And so there are a couple of details we have to look at. So the first thing is the historic costs. We also said it's called sunk cost or past cost. So we bought the cotton, in this case we bought the cotton for 150. We could simply sell the cotton now for €2 per kilogram. So that's the current market value then of the products we have on stock, so per kilogram. And replacement cost means if we want to buy it again, if we want to buy it currently again, a new, let's say fresh organic cotton, we would have to pay $2.50 per kilogram. And with this information in mind, we now have to answer the question, which minimum price should the clothing company pay for the organic cotton? And there are three options, of course, now. So we have the 800 kilogram, and we either multiply the 800 with 150, 2, or 250. And yeah, the question for you is now, what do you multiply this with? And if you remember what I said earlier, historic costs are never relevant for decision making. So it's either resale value or replacement value. And in this case, it's going to be the resale value, because basically we don't need to buy the cotton again. So it's irrelevant what the replacement value would be. And the only relevant cost would be the amount of money we could currently get for the specific cotton we have on stock. So it's the 800 kilogram multiplied with €2 per kilogram. So a minimum price should be 1,600, and probably you would charge, or we would charge a little bit more to make also a little bit of a profit with this. Let's now change one minor detail. It looks like a minor detail, but it actually is a very important detail. Let's say it's the same case study, but let's now say the cotton is in regular use by us, because we also use the cotton for our own products. And so in this case, the minimum price would change. We still have 800 kilogram. Historic costs are still not relevant. But what about resale value and replacement value? In this case, we would have to take the replacement value, because if we use the organic cotton in our in the contract with the other company, we would lose the 800 kilogram. And so the only option we then have is to buy it again, because otherwise we cannot produce our own products anymore. And so in this case, it's 800 kilogram multiplied with a €250 per kilogram, which makes it 2,000 as a minimum price. Because let's say in the alternative situation, if we would sell it for this price per kilogram, we would actually have a little bit of a problem because we pay 250 and we sold it for 2. And so we anyway have to get new cotton, and so we would pay more than what we sell it for. And that, of course, would not be a clever decision. So in this case, it's €2,000. And again, here we would add a certain margin to have a little bit of a profit. And here with these examples, you can see a little bit how costs can be classified as relevant and irrelevant. And of course, depending on the situation, the details might change. And that's why also in the homework, we're going to train with this a bit more again.